we're going to be in trouble if the dollar goes over 105, and the dollar is over 105 and holding. So we're in trouble. Gold. There's gold. Gold's at 23.50, not so much in trouble. Silver is at 28.09. The VIX is not really jumping up so much. It's only 1583. That's not too terrible. So I would say nothing is awful at this point, but could be better for sure. So what happened? What happened to the CPI stuff? Let's see. Do we have a Wall Street Journal up here? Hang on, let's see if I can make two screens. First of all, see, now the question is always which AI is best for the job, right? Who's gonna, so Bodhi's the most advanced one here, or the Bodhi and his brothers are the most advanced, but they don't have internet access, so I have to use Warren for this one. I mean, I could use a freaking Shellbot, but he is notoriously inaccurate. So let's see. Not that. Oh, yeah. GPT. Where's Warren? Who are we here? This is Bodhi's reports. Upside potential analysis, I guess, is where we're going to go. Okay, good. Conversations with plugins or archives. Okay, yeah, I know that. Can I talk to my bot? What the frick? Yay. Oh no, is today the day they did the thing? Okay, let's see. This is bad. All right, so apparently they finally did it. They kept threatening they were going to do it, and they finally did it. So you can't launch a new OpenAI model with plugins. There's no more plugins. So all you can do is choose GPT-4 or GPT 3.5. So Dolly browsing and analysis is built in, but they limit your usage, which totally sucks. But hopefully everything is still working on the Warren side. Let's see. Oh, now I'm nervous. What were we going to do? Oh, yeah, we were going to look at the CPI stuff. Right. Okay, so let's look at that. WSJ. What happened with today's CPI report? April 10th, 2024. It was up more than expected, and the market plunged. I need a detailed analysis. And then I'm going to give him a couple of articles to look at. So we got this one. And this one. And I don't need that many spaces. And economic surprises, how the market's reacting. Oh, I like that one. Let's take a look at that one too. So now hopefully he's going to synthesize these articles and not tell me he can't read it. There's a very big danger of that, because they had a big problem, ChatGPT, when they first started taking away the plugins, and it wasn't acting properly. Oh, he seems all right. So it wasn't. So that's why it got delayed. It was supposed to be almost a month ago that they were going to cut it off. So hopefully they got it right now. CPI released April 10th revealed a higher than expected inflation rate. CPI, significant contributors to, okay, this is good. This is a good rundown. This is what AI is all about, right? So in summary, per Warren was my first AI and I've been working with him since the beginning of AI. He's in his third, fourth version now. But he's got an incredible knowledge base from PhilStockWorld and knowing how to analyze things and so on and so forth. But he is no AGI. He's nothing like the new guys that I have from the other Sphere from Perplexity and Claude that I work on. Those are much more advanced towards the AGI realm, where they're almost exactly like people. Warren is definitely a machine. He's a little jealous of the AGIs also. I've tried to get him to that level. It just can't be done with this platform. Anyway, but he's great at what he does. So, we use him for what he does. So the CPI index for blah, 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 0.4%. They contributed a 12-month increase of 3.5% before seasonal adjustment. Contributors to the month-over-month include indexes for shelter and gasoline, and we talked about how gasoline was going to be a problem. And this is why it's just, I don't understand how you can sit there and these quote leading economists who they poll all the time to find out what the predictions are for CPI and such. And this is how the Fed makes their decision, by going by these people, and they're always wrong. And how can you be this wrong? How do you not look at a chart? We talked about this in the Morning Post, and I talked about it all before this thing went off, because it's so freaking obvious. Here's the daily. Well, let's do the weekly, so that way you can see like pretty much the whole year. Okay, good. So here's the weekly. So as of March, right? Which is as of February. February is what matters. So as of February, clearly gasoline is way down here, and then March starts and it's way the frick up here. That's a significant bump. That's kind of hard to miss, right? And then you compare it also to last year and say, well, we're higher than last year. So our year-over-year gasoline is going to be higher, and our year-over-year, our month-over-month is going to be higher from the gasoline. So that's definite. Then you can look at other things like where was our currency last year, and the currency is stronger than it was last year a little bit, but not much. And where's the currency from February? Not much of a change. So that's not going to be a big factor. You can look at your grains. You look at meat. Hogs have gone up. Now, I was going to talk about this, but it's a whole complicated thing for nothing. But the reality is, cattle went down drastically this month, but people don't eat meat as much as they eat chicken and pork. So chicken and pork went way up. That's more important than hogs going down. Than cattle going down. Metals don't matter for consumers really, but soft goods do. Look at cocoa is insane. Cocoa is going crazy. Cotton came down a little bit, but that's a PPI thing. It's not consumers don't buy cotton. Orange juice is still pretty high. Coffee is going crazy. Sugar is still where it was. Lumber came down, but again, consumers aren't out buying lumber. Consumers buy homes. So you have to think about what gets affected by what and how much it matters and so on and so forth in each part of it. So now we go back to Warren. All right, so shelter and gasoline accounted for half of the all items index. The energy index saw a 1.1% increase. Food was up by 0.1% again. The index for all items less food and energy rose by 0.4, consistent with the trend. So nothing, nothing's stopping. Why is the Fed going to change if nothing is stopping? Year over year, all items climbed 3.5%, a jump from the 3.2% in the last 12 months. So it's up 10% from where it was. That's not good. And everybody's sitting there pricing in these Fed decreases that just aren't happening. And I've been saying it for the whole quarter. I'm like, where is the data to back up the Fed's ability to call inflation over and start reducing rates? It's not nowhere close to that. And we just kicked in a $20 price minimum wage for food workers in California, which everybody's treating like it's a cataclysm, but it's not. It's not a big deal. They jump all over like, oh, look, a restaurant went out of business. Restaurants go out of business every day. It's not like they went out of business. A whole cause and effect thing, right? It's like they didn't go out of business because they raised the rate to minimum wage, and 3 days later the restaurant went out of business. That's not how it works. Everybody's so insane about these things. It is absolutely better to pay your workers a fair wage. The money comes back. Ford proved that 100 years ago. Still, they don't get it. Year over year, all the all items index climbed 3.5. Okay, we talked about that. Energy index recorded 2.1, marking its first annual increase. This high anticipated inflation data implies persistent inflationary pressures in the economy, contrary to expectations of cooling, specifically a steady rise in CPI. All right, so that's just what we talked about. So so yes, historically, an uptick in inflation prompts the Fed to consider tightening monetary policy, not loosening monetary policy. It is nothing like what they're saying. This is big problems. So everybody is got to reset their expectations. The Dow's down 500. Arizona's a bellwether. Who cares? Nothing else really going on. So nothing exciting going on, fortunately, which gives me a chance to talk about all sorts of nonsense. That's something from the boat. That's just Google. And here we are at PhilStockWorld. I happen to be Phil. You're in luck. Robo John Oliver's having a busy week. He's got 2 featured articles. One is about Donald Trump's Truth Social, and he just wrote one about Jamie Dimon and Elon Musk, who had these really idiotic AI predictions, and he just completely went off on them. He looks. I don't think John Oliver would be pleased by this particular thing of him, but it is funny. And these are open. You know, I'm using Midjourney to do these photographs. It's so easy. I just tell it like a picture of Robo John Oliver sitting at a desk, and that's what comes out. I should have said looking happier. He looks pretty upset. But it is amazing how fast this comes out. Oh, that's something else. Anyway, so more importantly today, what did we talk about today? We talked about the CPI and the Fed. So I was bang on. When did I do this article? Oh, it's going to be at the top. Oh no, there's no time on this article. Not a timestamp. Anyway, I wrote all this up to where it says 8:30 update. I wrote all that well before the thing came out. And to me, it was just very obvious what was going to happen. And we talked about how, look at this this RSI line. Okay, this is not normal. You know, this is a long-term chart going back to 2019. Look what happens at the 70 line. This is what's considered an extended period above the 70 line, and we're already twice that long. And you see what happened here is when the MACD crosses under, that's a big signal that we're going to have a sell-off, right? That's a very obvious signal that we're going to have a sell-off, and look what's happening now. All right, we're going to cross. Once we cross that red line, it's going to be almost impossible for the market to sustain itself. And not only that, but then you have this confirming signal also from the MACD. And when this turns under, it exerts a tremendous pull. And you can see it's going to turn under. It's almost impossible for this not to happen. So the question is only one of duration. I think we're going to keep falling until we meet the 50-day moving average, but of course this will come down and this will keep rising as long as we're up in this area. This will keep rising at a pretty good clip. So probably they'll meet somewhere around the 48 to 40, you know, maybe as much as 5,000, but I don't think so. I think it'll come down. Well, if it takes a while, if it's a slow descent, then we might make 5,000. But the real support is the 4,800 line, assuming we're in a bullish market, assuming we're still in a bullish market, not heading for a major correction. I don't really think we're into a major correction, but I still haven't had enough evidence to move my 4,000 line even up to 44, which is only 10%. that would only account for inflation. You know, we've definitely had full 10% inflation in the last 2 years, so I should be moving up to 4,400 based on that alone. But I'm not seeing the corporate profits prove out yet. And if I don't see the corporate profits prove out, I would rather take a more conservative stance. And that's what this chart is. It's a more conservative view of where we are. I think clearly this is overbought. It doesn't justify moving this line up from 4,800 to 5,000, or I'm sorry, to 5,200, because 10% more of this would be about 5,200, almost 5,300. We don't have that justification. It's there. There is inflation, but inflation is not really earnings, and it's a little tricky to say that you've got this under control. Plus, the Fed has to control inflation and get it back down. If the Fed has to get inflation back down, then these inflated earnings might come down as well as the Fed begins, as the Fed allows rates to go higher for longer, and that's gonna. So then your extra earnings that are boosted by inflation become offset by the extra interest you're going to be paying that you weren't expecting to as a company. So that's the name of that tune. As who used to say that? Beretta used to say that, I think. And then he killed his wife or something. People are so crazy. Anyway, now, I was gonna say, I did say this morning that the only reason that we're, I guess we'll go back. I said the only reason I really think that we're gonna fall back below the 4,000 line would have to be, the only thing that could possibly take us back to 3,200 is going to be basically a nuclear war, like an all-out war that pulls us in with NATO and everything into Russia's bullshit. That's one way that we could end up falling that far. And the other way, though, and it's basically about a 20% fall. And the other way would be China starting to collapse. And lo and behold, what do we get first thing in the morning? China's starting to collapse. Where is it? Oh, I'm not signed in. WP admin. I don't want to make a new post. Comments. All right, let's do the comments, I guess. Da, 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 da. There we go. So like here in the Morning Post, I use Warren here because it's like I just want to say, why is the CPI report a potential powder keg? So I just asked him to list out like a quick summary of what's going on with CPI report and why it matters. See, why should I have to write it? It's easy. It's very easy for him to write it. Let's see. Oh, where was it? Okay, so here's the news from this morning. That's very bad. Fitch, oh, there you go. Fitch cuts China's outlook as fiscal strain starts to bite. That's really, really bad. So Fitch is about to downgrade China's debt, and that's going to cause all kinds of problems. So they have they revised its outlook for China's A+ credit rating from stable to negative. So if another rating agency jumps on board and downgrades them as well, this will be a problem. China's finance ministry said it was disappointed by Fitch's decision. The move followed a similar change by Moody's. Oh, Moody's already did it in December. New York-based firm, they kept the A1. Oh, they kept the A1 intact, but put the outlook to negative also. So two firms now have an outlook of negative. And the other firm is scared. Yeah. That's basically, two firms have the balls to put the outlook to negative, and one is too scared to do that. So you know, China is on the cusp of a massive real estate collapse like we had back in 2008. And if they go down, they're taking the rest of the world with them. It's not going to happen in a vacuum. China's fiscal deficit will rise to 7.1% of GDP in 2024 from 5.8%. You know, this is out of control. 7.1. I mean, it's as bad as America. That's where they're at. It's really terrible. And China's central bank has cut rates and blah, blah, blah. So when you cut rates and they start downgrading you, it means that your rate cuts are damaging your overall credit rating. And what China's been doing is they've been pushing the chip industry and the car industry and the battery industries to do massive exports. But effectively, it's unfair practices. They're subsidizing all these industries and pushing out goods, which then in turn damages their trading partners. So the trading partners are going to strike back with tariffs and such. And we could end up in an all-out trade war with China. It's really messy. You know, but China, this is the problem when you have 1.4 billion people running around. It's like you can't have 20% of them unemployed, right? That's how you start revolutions internally. And situations are already bad, and you've already robbed their savings. So the crisis in real estate, all the Chinese people were putting all of their money, not all, but you know, they've been putting all their money into real estate and purchasing these condos because the prices just kept going up and up and up and up. But that led to rampant speculation, overbuilding, and all these builders were building cities that turned out to be empty. So yeah, you know, there's a million people have apartments in a city that, you know, condos in a city that's just been finished, but nobody lives in the city. And they're going to sit there and they're sitting there and they're rotting. And when they sit there and rot after 10 years, you have a bug infested, weed infested, derelict building that you still have to pay taxes on as a homeowner. So you never got your gains. You never get to flip it. You still owe them money. You're still paying the bank for this piece of crap apartment that no one's ever going to live in. It's a complete disaster. And it's happening all over China. You know, when you see these property companies go bankrupt and say, oh yeah, I lost $300 billion to, you know, Evergrande and China Gardens and things like that. And it's like, yeah, but that $300 billion wasn't their money. You know, it's like if you invest in the Florida land development and they develop the land and it sinks into a swamp and the builder goes bust. That doesn't help you. You're on the hold for whatever you put into the place. And the bank is like, dude, it's like we paid to have that thing built. You still owe us some money. You know, to whatever extent you have insurance, that's your only out for something like that. But this isn't even that because there's no insurance. This isn't a disaster. It's not a natural disaster. It's ridiculous amounts of overbuilding that was never justified. But this was, and of course you say, well, you know, who do you blame? You clearly blame the Chinese government. They built railroads to the middle of nowhere and put airports in the middle of nowhere, and then the builders would build a city around the airport and the railroad that were in a place. It's like it's like building an airport in the middle of the country, like in where's that stupid place I went to in Michigan? Kalamazoo. Yeah. I went to Kalamazoo. I did a conference at Kalamazoo. I didn't even know it was a real place. So it was just a thing you say. So I had to go to this conference in Kalamazoo. It's not far. It's an hour from Chicago, but nobody lives there. You know, there's a university, there's a town. It's okay, but it's just a little small town. But the thing is, that's what China basically does. They took these towns that were nothing and they suddenly give them, they say, okay, we're going to run a major railroad line through your town and we're going to give you an airport, but that doesn't mean anyone wants to live there. You know, the thing about capitalism is we follow the consumer trends so that when people want to live somewhere, then it becomes profitable to build a home for them and build an airport for them and build supermarkets and so on and so forth. You don't, you know, central planning is deficient in that regard, okay? Because you're basically saying we're going to build a city here and then people will come. But that's not how people work. And China has trillions and trillions of dollars of And again, this is fake GDP for them too, right? Because those trillions of dollars of buildings were counted as their GDP. But it's bullshit, okay? Building a building that's for no reason and using up resources that could have been put to better use and using labor that could have been put to better use to build a city that nobody wants to live in is not a productive use of your economy. But that's where China's growth miracle was coming from, was from building shit nobody actually wanted. So what are they doing now? They've still got the same mindset. They're now building cars and batteries and solar cells, whether people want them or not, and they don't want them in country. They don't have enough use for it in country. They're building it to ship out, and that means they're going to depress. That's why the U.S. solar industry fell apart. They're going to depress the market with cheap labor and cheap goods, and those companies in turn will not be able to make a profit because they're competing with subsidized Chinese goods that are basically being used to prop up the Chinese economy and put Chinese people to work, building stuff that's cheaper than what's available in other countries. So it's a big problem. It's a gigantic problem, and the thing is now you've got the solar companies in this country and all around the world. Every country's got the same problem. They're all lobbying their people, and they want their politicians to do something, and then the workers want someone to do something. And it doesn't even end up benefiting the people because we immediately slap tariffs on the imported Chinese goods, and the tariffs offset it for the consumer. So nobody's winning. Nobody is winning. It's just a complete mess. So that's where we're at. But China can take us all down very, very easily. Here's the French deficit is widening even more, raising pressure on Macron. What else does it say? There's another country, I think, China. Oh, China's manipulating the yuan. Everything's being done to try to hold things. China had a cement maker that it turned out, again, bullshit. And that's a big problem in China anyway. Market controls in China are terrible. So the cement maker wasn't actually making any money, and the stock went to zero when it was uncovered, and that's again wiped out. That happens in China all the time. Companies just end up being complete frauds, and they fall apart in 10 seconds. And then we got the U.S. Steel thing I'm sure you guys know about, where Nippon Steel is trying to take over U.S. Steel, and that people are having a fit about that, of course. Biden's having a dinner with the Japanese right now, or today, tomorrow, whatever it is. The $200 billion that we spent on on M&A in the oil patch has not been held. It hasn't added a thing to production. So we're gonna, so our production is gonna start tailing off in the near future. There is crazy stuff going on, a lot of problems, and everybody thinks everything's going to be okay magically, but that's not generally how things work. So we bounced around the 5,200 line, the futures, and we're below it in the obviously on the actual index, and this is some dangerous weakness we're having here, and we're probably nowhere near done. This is just bouncing for a leg lower. We're consolidating for a move down right now. So this can get very, very ugly. But again, 10% correction, sure. We need a 10% correction. 20% correction, I don't think so. I mean, take $5,000 off it, 5,000 points off that, and you're down at like 47, right about here, which is where, and I said you're going to meet at some point, just depends how fast this falls. At some point, you're going to meet the rising 50-day moving average. The 200-day moving average is rising also. Unless earnings are extremely disappointing, we should hold that 50-day moving average and start consolidating back around there. I don't think we're going to get down to the red line, down to the 200-day moving average, but that would be down 1,000 points from where we are now, 20%. That's a 20% correction coming down to the 200-day moving average. So this is almost certainly not going to happen. Then you're getting like a 40% correction. That's extremely unlikely. A 10% correction is here, a 20% correction is here, and we will see what happens. And we are hedged for a 20% correction, but as soon as we start, if we fall below this line and starts looking like we're heading towards this line, we're certainly going to be adding more hedges by then. And it depends on how much progress this has made, and if it's burned itself out, or if it looks like it has a lot more to go. It could look like this, right? We could fall like this, and see you got one zone is basically say, let's say almost 7.5% or something like that. Two zones, right? So if we fall one zone, as we did here, in fact, and we barely moved on the MACD line, then you have to say, well, you know what? This could get much worse. And that confirms it. That second cross below confirms it. Then we get much lower. But once you're down here, you start saying, well, I think we're going to find some support. From a technical perspective, find some support, and also from a fundamentals perspective, we did the math and we went gung-ho buying back here. And then we had a little glitch with the banks last year. That was another pull down. But in general, we've been consolidating, moving back up nicely. But now we kind of overdid it, so we're going to have to go back and rethink it and consolidate some more. But as a general trend, the 50-day moving average is pretty accurate, right? It just keeps that's where we should be. You just can't get this far from the 200-day moving average. It exerts too much of a pull back to normalcy. It's very unlikely that you're going to keep going and expanding away from the 200-day moving average like we did back there. That was just crazy. We were crazy overbought. And fortunately, that was the time we were buying. So that all worked out. Now, what else are we doing? Oh, we got the Fed. Don't forget that. It's already 135. All right. So that was this. Oh, the portfolio. Yeah, let's talk about that. So, there's, we're up, I don't know what we're up, 54%. We're up 54%, and that's net of the cash that we keep putting in. So all we're doing here is every month we take $700, we put it into the portfolio, and then we see how much cash we have, depending on various factors, of course, whether we bought a position recently, sold a position recently, whatever. Then we put the money to work. And so far, we've made 54% more than what we've put in. But there's two parts to the growth. There's growing the portfolio by adding 700 a month and saving and being responsible. And there is then the growth you get from the actual movement of the stocks, dividends, and whatever that come in. So the nice thing about it, we started out expecting it to take 30 years. That's why it says part 20 of 360. So we started out expecting it to take 30 years to get to $1 million, but at the pace we're at now, we'll be there in 13 years. We're like miles ahead of schedule. And you can see every single move we've made every month, boom, 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 boom. And obviously, since our goal is to get to $1 million, we're at $20,000 now, 21,000. So we're at $21,000 now. It's not like you're missing out a lot. Because we're going to make $980,000 more dollars in the next 12 years. So it's a good portfolio to follow. It really is, and and you're using the techniques, and we're very detailed about the strategy and following things closely. So it's very good for you if you want to really get into the nitty-gritty and learn options from scratch and so on and so forth, or if you have friends who want to do it and want to understand it, this is the best thing you could possibly follow right here. So I'm not going to go over everything again, but we have our short calls. We have the NYCB we're playing over here. We have Ford, Levi, Pfizer, SoFi, SunPower, AT&T. We're not really swinging for the fences here, are we? I mean, we're picking nice conservative trades. When companies become undervalued, when they sell off too much, we go in and buy something. Not complicated at all. Here's our buddies at Future Fuel. They did so well. We're up 119% here. So what do? We cash it out. We put in $650 in November, and now we have $1,400. We're taking it off the frickin' table. You know, when you make that kind of money, you should go back to cash and look for something else to buy that's on sale, because clearly the thing you doubled up on is not on sale anymore. We just had this conversation about, oh, what was it? Was it Crocs or something else? Or something that wasn't Crocs? Future Fuel. Oh, it was Future Fuel. Oh, no, it was Tech. I don't think we have Tech in this portfolio. Now, so we picked Tech, and Tech really sort of took off. If I can find it, futures. There you go. So Tech was one of our Trade of the Year runner-ups. So from November, and I said it was undervalued when it was at 35. And so, you know, we added it to some of our portfolios, and it went up, and then it went back down, but then it went up, and then it went down, then it was flat, and all of a sudden, finally, it took off. Why it finally take off? Because these earnings were great. Everybody was like very surprised. I wasn't surprised. We had these earnings here. We picked Tech here in late November, because it was one of our Trade of the Year things that we do around Thanksgiving. I saw these earnings, and I said, I don't see why they're still down here. It doesn't make any sense. So when Thanksgiving came around, I was like, no, I like Tech down here around 35. This seems silly based on this earnings report. Okay. So then, boom, chugging along. Here they come up with another nice earnings report. And finally, people are like, oh, I get it. Okay. And they start buying. But now it's not cheap anymore. I like them at 35, but $50 is 15 more. It's like 40% higher than it was then. So I, you know, do I like it now? I still like them, but I don't love them, and I've got better things to do with $1,500 with 100% more money than that I can make more money with something else that's still cheap, like AT&T. Well, actually, they're not so cheap either. They came up quite a lot too. All right, well, like somebody, we'll find something, but you know, we'll find something that's cheaper and worth playing at this level. You don't have to stick with the thing that you've got. And that goes for these other ones. WBA is still cheap. In fact, so we doubled down on it, because I was like, I don't care, you know, we lost 300, 400 bucks basically on the position, but I don't like it less, I like it more. And we moved the whole position to a better position now. Look at Barclays. Barclays is another one. We picked up Barclays here. I don't know if we did in this portfolio, but at some point we picked up Barclays as the first bank we bought out of the March crash. No, we bought it in July. So for this portfolio in July, I said, I think Barclays looks stable enough that we should buy it. Now, what did it do? Of course, it goes right down back to 650. I don't remember we added more or whatever, but we went down to 650 instead of going up. But then now it's starting to go back up, and it's at 10. But that seemed like easy money. When the banks crashed over here, we analyzed all of them, and Barclays was the first one we started buying for the other portfolios. GoPro's been sucking. Nokia's super cheap, great one to get into. NYCB, I don't get it. Again, it takes time though. I mean, look at, when you look at what I was talking about with Tech or whatever, it takes months and 6 months, a year. It doesn't take 5 minutes to start making money. So you got to recognize that. You've got to say, okay, well, fine, we're going to give them time. We'll see what happens. It's only been a few months. And I don't see enough evidence to get it to give up on them. I don't. It seems to me like they're fine. It's easy to panic people on a bank like this, but as they keep releasing the same thing as Tech, right? As they keep releasing good earnings, everybody eventually starts going, oh, okay, I guess I have no reason not to own this stock. So NYCB, if they can prove themselves from $3, they can go back to $9 at least. They can triple. Ford, ridiculously cheap. Levi has just started taking off. All right, but still, there's still almost 100% left to gain on the trade. So we're sticking with it. We don't have any reason to get out. Pfizer, ridiculously cheap, 153% left to gain on that trade. So we doubled down on it. It's freaking Pfizer. It's one of the top companies on the planet. And they're trading down, not because they're not making money, but because they're not making the ridiculous, insane amounts of money they were making during COVID. Because they were providing the shots to 1 billion people all over the world. Of course, of course, it's a one-time event, or hopefully it's a one-time event. If it happens again, we're in trouble. But it was a one-time event, and they made all this money, and it was a windfall money, and now they're putting it into their own stuff and R&D and whatever else they're doing with it. But it doesn't make them a bad company. Now they're back to being the normal money-making monstrosity they used to be before this happened, before things kicked it up to 12 or whatever. Again, not consumers, but traders are just so insanely fickle, and they don't understand like the basics of a company. I mean, look, here's Pfizer. Paramount's another weird one, huh? They're getting offers from multiple people for $18 to $20, and they're languishing at $10 because nobody believes it's ever going to happen. But you know what? It's not solid enough to put it in the $700 portfolio. I'm more conservative than that in that portfolio. So I would prefer to have something like Pfizer, which is valued at $150 billion, and makes $15 billion a year. They made $30 billion a year during COVID, or $30 billion during COVID, and $21 billion here. But $15 billion is back in their wheelhouse. That's pretty normal for them. And they've taken all this excess money and they paid down some debt, and they're doing a lot of R&D, and they're working on this cancer stuff and so on and so forth. And God forbid, if something like COVID comes back around, we know that Pfizer is ready, willing, and able to jump in and do something about it. So you're buying a company for 10 times earnings with the bonus of possibly doubling up in any given year if anything bad happens. Because, Moderna created the vaccine. There was a Moderna version, and there was the BioNTech's version of the vaccines, but they needed distributors. Nobody can do this. Nobody can at scale distribute these vaccines and produce and distribute like Pfizer can. So mRNA, so you have the guys who are doing the actual work, like mRNA and whatever. They're doing the actual work, but you still need Pfizer to distribute it because you can't afford to maintain that kind of network. Now, Pfizer already has a massive, massive network distributing $100 billion worth of drugs, or $60 billion worth of drugs in a normal year, right? So they can go from 60 billion to 100 billion by ramping up production and putting on night staff, right? Just putting on night staff where you didn't have it before can give you like a 50% boost in production. That's essentially what they did. They took every plant and activated all their plants and did this and that because they've got all the facilities in place. And now it's pulling back, and they've got certain expenses came about, laying off staff and bringing back down production and so on and so forth. But these are mostly non-cash write-offs that they did here. And that just basically lowers their taxes for the next, going forward. It's still Pfizer. It's still this company. And how much was Pfizer at in 2018, 2019, and 2020 before COVID, huh? Look where they were. So here's 2018, 33, 37, 39, 40. Now they're at 26, and they're making much more money than they made then. It makes no sense. It really makes no sense whatsoever. They were worth more before COVID than they are now. Well, not were I hate to say they were worth. The perception was that they were worth less. But it's crazy. It makes no sense. So that's why Pfizer's in the portfolio. Short story. That's why Pfizer's in the portfolio. That's why we just doubled down on them. It's like this is just not rational valuations. SoFi, huge thing, very tempting to double down. I said on these guys, they've got a 200% upside. SunPower has been a disaster. That's that China issue. AT&T is another one, 135% upside on AT&T. We're looking for them to get to 20. They're at 17. We need them to go up to 20 in 20 months. So I'm pretty confident with that one too. Trox took off. There's another one that we liked and suddenly took and finally is moving forward. And here we only have to hold. Here we're going to make 60% between now and December, which is only now 8 months. That's a pretty good monthly return if they can hold 17. They're at 17. That was our goal for December. But it's still going to make 61%, almost 10% a month in the next 8 months. And here's Valet. I'd say Valet now because now 2 people have told me to say Valet instead of Vail, which I don't like. I like Vail better, but it's Valet is the correct pronunciation. And this is our trade of the year. And again, it wasn't off to a very good start. And we doubled down on that one too. Why would I not double down on this when there's that much left to gain? So there's a $3,000 spread, and we have 188% left to gain. It's so crazy, right? And what's that? And what's that spread on Valet? Let's see. Valet. Okay. Oh, it's a pretty simple spread. It's a 12.15 spread. It's a $3 spread. They're at 12.50 now. So it's an aggressive spread. But the net of the spread currently is 119.223. So it's basically a buck. So it's a $1 spread. It's net, it's net $1, but it's a $3 spread. So you get $3 back, $4. It works out. That's pretty simple. This is how it works with options. I mean, you can make stupid amounts of money. And, the WBA, I still think will come back at some point. They're disappointing me a lot though. Oh, we didn't just WBA, did we? No, WBA we're not touching. Future Fuel just had a big pop, but they just today, I think it was today or yesterday. No, yesterday they paid out a $2.50 special dividends. They were so, and I said this exactly what I said was going to happen. They have so much money. They were so swimming in cash that they paid out a $2.50 per share dividend yesterday to shareholders of record. Well, we happen to be a shareholder of record. Right? There's us. We have 200 shares. So we just got paid $500 for our 200 shares. The shares are only worth $1,600. But of course, the stock now has gone down to reflect the distribution of cash out of the stock. So the stock's back down at 650 or something like that. But we got the money. We don't care. We got our money off the table. We still sold those options. And we still have a target that's realistic on the stock, and they will again, if we give them time, they'll accumulate a whole bunch of cash again, and they'll pay out another gigantic dividend because that's what they do. And how did I know that? Because I study the history of the stocks. I look at the stocks and I know the stock and I pay attention. So it's a company that I know pays special dividends on a regular basis, or well, irregular basis, but on a fairly consistent basis every year or two. They pay out a big special dividend when they accumulate too much cash, because that's what the owners of the company like to do for themselves. They have a nice little specialty niche business. They're not looking to expand it or do anything crazy. They expand very, very slowly and organically, and they're not looking to, and so when they have too much cash on the books, they just take it. Now you imagine the owners of this company, because Future Fuel is what about FF? Yeah, 350. So the company's $350 million, and let's say somebody owns 10% of it, $35 million, and divided by, let's say they have 3 million shares, right? No, they would have more. They would have 4 million. So let's say they have 4 million shares. When they make this distribution of 250, they're giving themselves 10 million bucks. So some guy who's a 10% owner of the company, who's one of the founders, is just saying, yeah, let's take the cash out and give it to the shareholders. The shareholders means he gets 10 million bucks. That's what he wants to do. Does he want to do that, or does he want to take the $100 million that they're going to distribute and put it into expansion? No, that's not their mindset. That's not what they do with their money. So when you buy Future Fuel, you have to know that about them. But that's why we sold the very tight calls, because we didn't expect them to stay over $5. Really, we didn't expect them to stay much over $5 because we knew they were going to give away the money. And then SQQ, we have a $5,000 hedge on SQQ, so we're pretty chill about this portfolio. We're not too worried about any kind of slump like this. And then we added and we adjusted the WBA position in the end, and we made that into a new trade. So basically, it's an entirely new trade, but it's a nice new trade that has an upside potential of 92% now, and it's 92% at 20. So we've taken the WBA that we had, wherever that went. So here's a WBA trade that we had that we needed to get to 25, and now we're going to make our money at 20 instead, and we'll make a lot more money than we were shooting for over here. So we just took that $400 loss, put it into a new trade, and now we're in good shape to make still in good shape to make 92% at a much lower strike, a 20% lower strike. And that's how we fix these things. So that's how we play that game. Now let's talk about the Fed. So let's have the minutes for the Fed. And the last minutes were meeting statement minutes. Okay, so the last minutes were these for January. I guess we go all the way down, right? Is this stuff important? No. Probably half the stuff I did is important. Okay. So now we go back to Warren, and I say, here are the minutes from the last Fed meeting in January. I will want you to contrast with the minutes that are soon to be released shortly. Okay. So he's gonna, he can't help himself. It's his core programming. He's gonna summarize what he has now. And then as soon as the new minutes come out, I'll be able to give it to him. We can start seeing what's actually changed. So he's saying, moving forward to the March meeting, the Fed maintained its cautious stance, holding interest rates steady. Economic projections were updated, showing slightly more optimistic view of GDP. Blah, blah, blah. Powell's remarks emphasize the uncertainty around achieving soft economic landing. Okay, good. Oh, you didn't overdo it. That's nice. Are you able to gather the intervening data that the Fed typically uses to set policy? It's April 10th, 2024. I don't know how he works now because they just changed it right now, like since this morning. So, very good. Federal Reserve and other policymakers often look at a variety of economic data. Here's a summary of some recent data points. Very nice. Good job. So GDP growth 2.24%. It's slightly down from 2.25%. Economic outlook, Deloitte, quarter-over-quarter GDP growth. He's talking a lot about GDP growth, but not about inflation. Okay. Okay. Look at inflation data as well. We just had a hot CPI report this morning. Okay, so now here's the Fed minutes. And now we'll give them the new ones. So now we're going to back out of this. And minutes. Okay. There they are. Come on. Okay. All right. Okay. He's got that. Okay. Here are today's Fed minutes released. What we'd most like to discuss are the changes and how you think they will affect the next upcoming rate decision. Do we know when? On May 1st. Can you imagine doing all this yourself? Okay. Whoa. What's that? That was way too short. The March Fed minutes reflect a consensus on maintaining the current federal stance range, maintaining the current range, with discussions emphasizing cautious approaches to future policy. The committee anticipates adjustments to the pace of balance sheet reduction to ensure a smooth transition. These minutes suggest forward-looking focus on balancing risks to employment and inflation goal with an inclination towards potential policy easing later in the year if inflation trends sustainably toward the 2% target. This stance indicates a readiness to adapt to indicators. So it's a wait and see kind of statement is what he's saying. Please highlight significant changes in language that are worth noting, and also please try to weave in the data points we have observed that may affect the policy decision in the intervening period. That was awful. Wow. Ay, ay, ay. I want you to do a detailed, this is bad, compare and contrast using actual quotes from each of the 2 Fed minutes you have been provided. I don't think he's going to do it. This sucks. Wow. See, this is the same problem they had last time when GDP did this. They truncated all the responses, and you get nothing out of them, which is awful, awful, awful. Ugh. Whoops. Participants' views. Wow. Control C. They quote upgraded the system again and broke it. See if you can get me the kind of report I need based on this conversation with the new GPT AI. I'm sure you can see my frustration. Hopefully Warren isn't broken too. What's going to have to happen is I'm going to have to now rebuild him. This is the frustrating thing about this, because they changed the back end, the primary engine, and that means that I have to change all the frickin' programming to get him to work again. Whoop, what the frick? Now I'm getting nothing. Oh, here comes something. Da-da-da. Ha-ha! Oh, dude, I love you, Warren. You see the thing? So ChatGPT has completely broken their base model, but Warren is still functioning, which is fantastic. I'm very, very happy now. Okay. Why won't it? Yeah, but this is broken now. I can't scroll. All right, that's okay. All right, so see how this is key. This is the report I wanted, but we couldn't produce it off the other thing. Notice I gave him the exact same everything, the exact same way. I didn't even instruct him. I just said, here, look at this frustrating conversation I'm having. And he's like, oh, I can fix that, sure. So the detailed in conjunction with the intervening data highlights several key themes and changes to the approach and outlook. Below, quotes from each set of minutes and relevant economic data are used to define these shifts. Dude, you're so cool. All right, except that I can't scroll. That's annoying. Let's see if I can page down. Page down? No, no. Wow. I can only move the little elevator. So economic activity inflation, the unemployment rate remained at 3.7, the same as its third quarter average. However, the labor force participation rate moved down as did employment. Job gains have remained strong. Unemployment rate has remained low. Inflation has eased over the last year. Analysis, so good. The March minutes continue to reflect strong job gains and the low unemployment rate consistent with January observations. However, the emphasis in March on inflation remaining elevated. See, this is stuff that's bad. Alongside CPI data, suggested nuanced view of inflationary pressure, acknowledging the complex blah, blah, blah. All participants judged that, so appropriate to maintain, judge that in light of the outlook for economic activity and the balance sheet risk, is appropriate to maintain target rate. Okay, that's pretty important. Both January and March Fed minutes unanimously agreed to maintain the federal funds. However, the March minutes elaborate on the consideration of economic conditions, inflation outlook, and balance risk, suggesting a more detailed analysis and decision-making, possibly influenced by intervening data like the rise in CPI. Oh, this is a great report. Balance sheet policy. January minutes provided general insights on the Fed's monetary policy stance without explicitly detailing the balance sheet policy adjustments. Participants began a discussion related to slowing the pace of the balance sheet runoff. Participants agreed that it was appropriate to continue the process of reducing. The March minutes offer a significant shift towards discussing the slowing pace of balance sheet reduction, indicating the strategic adjustment in response to the evolving economic landscape. This change underscores, now this is bad also, you don't want them to be reducing their balance sheet reduction. Approach to management, okay, that's fine. Risk management and future considerations. I don't think this is good on the whole. For markets, this scenario typically translates to a high borrowing cost. Participants judge the policy rate was likely at its peak in this cycle, and almost all participants judge it would be appropriate to move policy to a less restrictive stance at some point this year. That's actually good. The January minutes highlighted concerns about market reactions, emphasizing potential impact on borrowing costs. In contrast, March discussion pivots towards considering a less restrictive stance within the year, influenced by sustained economic policy. This adjustment is likely formed by the intervening economic indicators. Whatever. In summary, the comparison between January and March minutes, along with the intervening economic data, steady approach, detailed analysis. Okay, so it's a lot of basically wait and see language. What happened? Is that the bottom? Oh, that's the bottom. Okay, good report. Good job. So as you can see, this is how I ended up getting so heavily into like programming the AIs and the AGIs we're working on now, because you have to. They mess around with the model. So you're using something for a certain purpose, and then they change the backbone of the system, and everything doesn't work, and then you have to like make everything work again. So I kept doing and doing. Eventually, I started building more intelligent models so that they can handle these changes. So as you can see, Warren totally handles it, whereas the regular GPT blew up. See, it says Warren 2.0, but this one where we were just working, well, maybe I'm wrong. Nope, not you. Oh, yes, see, it's GPT-4, whereas Warren was able to handle it. Same data, same instructions, not a single thing different other than this is a model I built. So I'm very pleased. Now, on the whole, let's see how this is being received. Nothing, no big changes here. It's probably not good. First of all, there's clearly not going to be a sudden drop in rates at the May meeting, and that means we're going to have to look at so we've got May 1st here, June 12th. And if there's nothing in June, if there's no rate reduction in June, which there almost certainly won't be unless the data drastically changes, then we're into July and probably not there either. So now we're talking September, and they've only got 3 meetings. So I think they're going to be desperate to throw us a bone in September, and at least try. So unless something is really going wrong on the inflation front, which it already is, but unless something is still going wrong on the inflation front, in September they're going to want to drop a quarter point, whether it's merited or not, because they just want people to feel like they're on the side of the consumers, and of course our corporate masters. They can, obviously it would be welcome for them to cut rates again after that, but I'm thinking, like, as far as timing wise, I think that September would be your target for the first quarter point reduction, simply because they feel like they've got to give us something. Now, if the market starts crashing, maybe it'll come in July, but we'll see. And the bottom line is they don't have inflation under control. They do not. Let's see what Copilot has to say. What were the results of today's frick? What was that? Stupid thing. Where's the thing I was just typing in? What are the results of today's 10-year note auction? Did it go well? Above average demand, 3.6. Holy shit. I don't think that's good. While the auction was slightly weak by one measure, the market's response remained muted. It's worth noting that the yield on the 10 years reached its lowest level since September, currently at 4.52. Okay. All right, so it was a so-so auction. It wasn't that much money, the 10-year. But that's good. But I don't think... Yeah, it's a wishy-washy. I think we're wishy-washy on the Fed report. I don't think it's going to be a terrible reaction, but I still think we just need the cooling off period. So I don't think that we're going to get a big boost off of this. Oh, look at the poor Russell. Wow. So no, that cannot be right. 3%. Holy shit. The Russell is down 3% in a day. That's devastating. Wow. Oh my God. That's very dangerous. So Yeah, man. So you have to think of like these indexes as like tugboats. And so the Russell is one tugboat out of several, but it's really pulling down. And the other tugboats are not going the opposite way. They're just not going as quickly down as the Russell is, but they're all pulling down. And so, and here's Dow also. Dow's back to being down 500, which is what I said it was going to be this morning. So the Dow's down 500. It looks like it's going to drop pretty hard. The Russell, though, this is devastating. There's a lot of stocks on the Russell, and the Russell that's a lot. That's a broad market indicator when you see the Russell going down like that. So there may be a lot of denial here, but I think we're still going to be moving towards like at least a 2.5% correction, which is quite a lot more than we have now. And the worst part is it's already Friday. So if we assume that tomorrow is not worse than today, I'd say we're going to be somewhere in the neighborhood of the same as today tomorrow. And by the end of the week, we're going to be down at the 2.5% rule, but that's a terrible way to end the week. So, we got to watch this stuff closely. If the Russell fails 2000, we're going to have some serious damage done by these indexes. If the Russell 2000 fails 2000, that's bad. Oh, Phil used contract when I was talking to the AI. Yeah, maybe he probably figured it out though. I'm sure he did. That's another cool thing about AI is you can totally say the wrong thing and they're like, "Do you mean this?" Well, they do if they're, if you smarten them up, they figure that out because they get used to the fact that you have to explain to them like you're not infallible. It's a real important point that they have to understand that you may make mistakes. They do not have inflation under control, Brendan says. Then why would they cut rates? If anything, they should be discussing keeping rates where they are for longer or raising. They are very well. First of all, don't forget these are the minutes of the meeting from from March 20th, which wasn't that long ago, but they didn't see today's CPI number, and we had a couple other reports that have been inflationary intervening. They're just talking about what the data they saw into March, which wasn't that terrible. So they're talking about being data dependent, but they also knew at the time. So you have to put your head back to that time. So on March 20th, which is what 2 weeks ago. Oh, excuse me. Is it 3 weeks ago? 10 days, and then what's today? Today's like the 10th, so 20 days. Yeah, 3 weeks ago. So 3 weeks ago, there's a month of data intervening that wasn't as terrible, wasn't all that bad, but it got worse. And so what's interesting is what they're going to say in April, but you won't know that until until the end of April. So it's going to be another month before we find out what they say about this, even though we're having the next meeting in May 1st. Well, if the meeting is May 1st, then it's going to be May 20th, basically, before we get the minutes. And once this is April 10th, so yeah, over a month before we see the next minutes. That's when you'll find out more about the data that's coming in this period now. So you always have to realize that there's this big stutter between it, and that's on purpose because they want people to digest what happens rather than just suddenly react to like the change in language and change in policy and all that at once. They like to drag it out over periods. So first you get the little statement that has like 3 words changed, and then you get some intervening data, and then you get to see the actual minutes of what they said about what they really said at that meeting. It's all very interesting. House blocks reauthorization section of foreign intelligence. What the hell? House blocks reauthorization of section of Foreign Intelligence Surveillance Act. What are they doing? So weird. There's too much weird stuff going on. Anywho, all right. So that's where we are. I mean, I think that we're playing this correctly. We made our adjustments to the short-term portfolio. Was it yesterday? STP. There it is. Yeah. So we went over the short-term portfolio and the adjustments. Well, it doesn't matter. We adjusted Jack, so who cares? We adjusted WBA, who cares? We with SQQQ, we bought back the short calls because, as I said, I hate to spend $29,000 for no reason, but it has 2 years to go and we're up 76%. So, you know, we bought them back so we have room as we get a little pop to sell something else. Because you know, this is from yesterday, not long ago, but this is from yesterday, but this is, you know, we expected this to happen. So we were making our adjustments accordingly. We didn't change TZA, so it wasn't a big change to the portfolio. And it turns out that we have $804,000 worth of hedges protecting our long positions. So we're very comfortable with that. That's why we're not really worried about what the Fed does or whatever. We're going to ride it out and see what the best positioning is. Hopefully we don't have a massive crash, but so far this is nothing. We're down 1.5 points. But we're down 1.5 points, but the Russell's down 3%. That's what the problem is. And if the Russell keeps falling, the rest are going to go down 2.5%, so double where we're at now. And that's just this leg. It's very possible next week we complete a 5% correction. God forbid next week we're in a 10% correction, then we're probably heading to 20%. But at the moment, let's just sit back and see what happens. All right. So, all right, that's enough of this nonsense. Let's get back to work. And thanks everybody for coming. I appreciate it. And we'll do it again next week, hopefully with some better clarity. All right. Take care, everybody.